Global tensions are shaking the silver market like never before. Investors are witnessing rapid price movements as geopolitical conflicts, economic instability, and rising industrial demand converge. Silver, often overshadowed by gold, is suddenly at the center of attention, not just as a precious metal, but as a key barometer for global economic uncertainty. The question on every investor's mind is, will silver break its all-time highs, or is this spike temporary? Over the past months, the market has demonstrated extreme volatility, highlighting the metal's sensitivity to global events. With conflicts in Ukraine escalating, unrest in the Middle East, rising US-China tensions, and ongoing supply chain disruptions, silver has become the focus of both institutional and retail investors. Historically, silver reacts faster to crises than gold. Its dual role as an industrial metal and an investment asset gives it a unique advantage, and current conditions have created an environment that could drive prices to unprecedented levels. Observing these movements now could allow investors to position themselves advantageously before larger price surges occur. Understanding silver's surge requires examining the broader geopolitical context. Multiple overlapping crises have converged, creating a perfect storm for the silver market. Eastern Europe. The ongoing conflict in Ukraine continues to disrupt energy markets, particularly natural gas and oil, affecting both industrial production and investor sentiment. Europe's energy shortages ripple through global supply chains, creating uncertainty that drives investors toward tangible assets like silver. Manufacturing sectors that rely on electricity and industrial inputs are indirectly affected, increasing industrial demand for silver as a hedge against instability. Middle East. Political instability in oil-rich regions creates additional pressure. Investors tend to flock to precious metals during such periods of uncertainty. Any disruption in oil production or export affects industrial operations globally, reinforcing silver's role as both a safe haven and an essential industrial commodity. US-China relations. Trade disputes, tariffs, and tensions around Taiwan and other geopolitical flashpoints contribute to currency and commodity volatility. A weakening US dollar typically leads to higher silver prices, making the metal an attractive hedge for investors. Inflation and interest rates. High inflation rates and rising interest rates influence both investor behavior and industrial demand. Silver, unlike some other commodities, reacts immediately to changes in policy, reflecting investor concerns about currency devaluation and market instability. The convergence of these factors creates a complex environment, but history shows that silver thrives in such conditions, often moving sharply before other markets respond. Silver is unique among precious metals because it functions both as an industrial material and a financial asset. This duality makes it particularly sensitive to global disruptions. Industrial demand. Silver is essential in electronics, medical technology, and renewable energy, especially solar panels. Any disruption in production or supply creates immediate upward pressure on prices. The growth in solar installations globally has steadily increased industrial demand, adding to upward pressure during supply constraints. Market size. The silver market is smaller than gold, which means relatively minor changes in investment or industrial demand can create significant volatility. Unlike gold, which has a massive global market and higher liquidity, silver responds more dramatically to shifts in investor behavior or supply constraints. Safe haven role. During periods of uncertainty, investors often turn to silver. Its higher liquidity in smaller denominations makes it accessible to both retail and institutional investors. Historically, silver's price reacts faster than gold during crises, making it a leading indicator for financial stress. Analyzing the current market, several key factors are driving silver's upward trajectory. Price movements. Silver has surged in response to escalating geopolitical tensions. Over the past month, price movements have been faster than typical market fluctuations, reflecting both investor sentiment and industrial demand pressures. Supply constraints. Physical supply is limited. Mines cannot increase production rapidly, while industrial demand and retail purchases continue to rise. Shortages of physical silver amplify price movements. Investor behavior. ETFs and futures contracts have seen record inflows. Retail investors are buying physical silver, while institutions increase holdings in ETFs, creating pressure in both physical and paper markets. Industrial and investment demand. Interplay. Industrial needs, especially in solar energy and electronics, create a baseline demand. Investor speculation adds a second layer, making silver extremely responsive to global uncertainty. The combined impact of geopolitical tension, industrial demand, and investor behavior has set the stage for potential new all-time highs. Even minor disruptions in supply or additional geopolitical escalations could accelerate this trend. To understand what may happen next, history offers insights. 2008 financial crisis. Silver prices surged as investors sought tangible assets during stock market collapses. Industrial demand remained stable, but safe haven demand drove volatility. 2011 Silver Bull Run. Prices increased over 400% in 3 years due to a combination of industrial growth and speculative investment. ETF inflows and physical buying contributed to rapid price escalation. COVID-19 market crash. Silver initially dropped due to market-wide panic, but rebounded faster than gold as investors sought physical and ETF exposure. This highlights silver's dual function as an industrial and investment asset. Patterns show that silver often reacts faster than gold, making it a market leader during periods of global stress. Historical data demonstrates that sharp spikes are often followed by periods of extreme volatility, giving investors both risk and opportunity. The silver surge affects various sectors differently. Physical dealers. Coin shops and bullion dealers are experiencing shortages. High demand for physical coins and bars is straining inventories, pushing premiums higher. Digital markets. ETFs and futures are experiencing inflows at unprecedented levels. This affects liquidity and causes rapid price swings in digital trading platforms. Smaller businesses. Jewelers and local coin shops may struggle to source silver, while larger dealers and institutions may profit. The supply-demand imbalance influences pricing and availability across multiple markets. The interaction between industrial, retail, and investment demand intensifies volatility, creating an environment where rapid price changes are increasingly likely. Looking ahead, 3 primary scenarios may unfold. Escalation of global tensions. Silver prices could surge dramatically. Physical holdings would benefit most, while paper markets experience volatility. Historical patterns suggest that during heightened geopolitical conflict, metals like silver act as both a safe haven and a speculative instrument. Tensions ease. Prices may stabilize but remain volatile. Investors who panic sold could face losses, while early investors may see gains stabilize. This scenario reflects a typical post-crisis correction where metals react to both sentiment and industrial demand. Central bank intervention or currency fluctuations. Changes in the US dollar or monetary policy could lead to unpredictable swings. Industrial demand will provide a price floor, but market sentiment may drive significant short-term volatility. Scenario planning shows that preparedness is key for investors. Those holding physical silver, ETFs, or futures must consider both industrial and geopolitical factors when making decisions. For investors in the US, several key takeaways emerge. Diversify holdings. Don't concentrate solely on metals. Consider a mix of silver, gold, stocks, and other assets. Monitor global news. Tensions in Europe, the Middle East, and Asia directly influence silver. Staying informed allows for timely investment decisions. Balance physical versus digital exposure. Mix coins, bars, and ETFs. Physical silver ensures tangible ownership, while ETFs provide liquidity and ease of trading. Observe supply-demand trends. Physical shortages amplify price movements, and industrial demand sets a floor for pricing. Investors who understand these dynamics are better positioned to take advantage of the market's movements while minimizing risk. Will silver break its all-time high this year? Is this spike temporary, or are we entering a prolonged bull market? These questions are critical for investors. Observing market signals, geopolitical developments, and industrial demand will be essential to making informed decisions. Commenting and engaging with updates can provide insight into emerging market trends, as collective observations often identify patterns before institutional investors act. In summary, global tensions, supply constraints, and industrial demand are reshaping the silver market. Investors ignoring these signals risk missing opportunities or facing losses. Awareness, diversification, and timely action are crucial. Silver's unique position as both an industrial and investment asset ensures it will continue to be a focal point for markets in the coming months. The current environment may offer significant upside, but volatility is inevitable. Remaining informed and proactive will allow investors to navigate this critical period successfully.